Good afternoon, everyone. I want to welcome you all to our call today. So glad you guys could take time out of your busy days to join us. My name is Charlie Palmer. I am the Director of Marketing here at Secured Investment Corp. This is going to be a relatively short call today. We just wanted to introduce our guest and give you guys some time to take some questions. If you do have anything that you would like to ask about, just drop it in the chat and I will pass that along. I want to start off by saying we're very bullish about the company and where we're at in this time of some economic uncertainty. We show up every day. We're here to do the work, and we're bringing a growth mindset to what we do every single day because we've been here before. Lee and the other fund managers have navigated similar economic situations in the past. So we know we can get through this. And I know a lot of you have had questions over the last few months about how things are going. That's why we wanted to have this call to kind of give you some insights into what we're doing here at SIC. I'm really excited to introduce our guest today. We've been looking for someone to kind of fill the gap, and Andrew Benton has extensive experience in the private lending industry. In fact, to the tune of $1 billion in lending. He's ran companies from Texas to Boise, and now he's here in Coeur d'Alene, Idaho. We're really excited to have him. He brings energy and, more importantly, a vision for what we need to do. In the conversations I have with Andrew, he's focused on our private lending side right now, but he's chomping at the bit to get going on capital raising, and that bodes well for all of us, for the company as well as our investors. So we're really excited to have him here, and I wanted to bring him on the call today to share that vision. So without further ado, our managing director, Mr. Andrew Benton. Andrew, the floor is yours.
Awesome. Thank you, Charlie. Very, very happy to be here and excited to chat a little bit and just introduce myself. I was thinking maybe I could just jump into a little bit of background, talk about, what we're focused on from a management perspective for our funds and, related to our investors and the lending we're doing, how we're keeping risk under control, where I think we can improve in areas that we are improving actively, and then also what's ahead in terms of the next 6 to 18 months, what our goals are and how that lines up with providing superior risk-adjusted returns to our investors and their funds, and also those who buy our notes. So I'll kind of jump into that, and then I'd love to have a little Q&A, maybe answer some questions from people who are actively invested or considering investing in private lending. By way of background, I guess I'll just get into it, and let me make sure I'm all. Charlie, can you hear me okay? Is everything good? I'd love to get a little feedback.
Yeah, Andrew, you're coming in loud and clear.
Fantastic. Okay. Thank you, sir. So by way of background, I started flipping houses in Los Angeles in 2012. And at that time, it was a risky proposition. People didn't think residential real estate was going to do well. They were concerned that there would be too much supply in the market, that there would be too many houses and no one would want to buy them. And so that was 14 years ago. This was the market that I was investing in. And we found some pretty early success, and people who invested alongside myself in some of these early deals. These were just flips. We actually flipped mobile homes. We flipped houses, and the people who invested with us got pretty good returns. And it was apparent to me that this was something I wanted to do. And so really that's how I got into real estate was that early experience flipping mobile homes and houses. And I met a fund out of Beverly Hills at the time, and they were looking for someone to come on as an investment analyst. And I met this fund because I wanted a loan for a large project I was going to do. But when I found out this idea of investment funds, where a targeted pool of money was set aside for a specific strategy and they could invest on a repeat basis over and over again, that was amazing to me, because I had to go find money for every deal I was doing. I love the idea of getting involved in fund management. And so I did. I joined a fund, and this fund that I was a part of was actually We were actually flipping houses. So we flipped in that year, we flipped 50 houses through that fund. We probably did maybe about $20 million of real estate. And then that fund partnered with a lending company that was just getting started doing private lending. And they also needed my help underwriting deals. And so I've been underwriting private lending opportunities for about 13 or 14 years now. 14, I guess, if you include my own deals that I was doing. But that was how I got into funds as an underwriter, and I've really been an underwriter ever since. So the perspective I bring to being a fund manager today at Secured Investment Corp and our funds really comes from doing it myself back in 2012 and 13. I also flipped a house in 2014 and I lost $80,000 doing that. So I know what it's like to lose a little bit of money and have a deal go south. But that background's really informed the way I approach to building a lending platform today. I'll talk a little bit about lending platforms that I've been a part of. So in Los Angeles, I was part of two different lending platforms. The first was a residential focused lending company, and we had a private fund. We grew from the time I was there, we grew from about 10 million to 150 million. I just happened to join at the same time that they completed a strategic partnership with a large capital provider, and we were able to grow the platform and not just do fix and flip lending, but also do construction lending. From there, I joined another platform where I was the first employee, and we grew that platform from, I think we had about $10 million in loans when I joined. And when I left, we had a little over a billion, maybe a billion, $1.25 billion in loans in the portfolio. So that was a place where I learned a lot about just risk and how to underwrite. And that was called Parkview Financial. So we were doing large construction loans and commercial construction loans across the U.S. And we started out as a regionally focused lender, and we expanded the platform across the U.S. while maintaining our quality controls as we scaled, and especially quality controls within underwriting, how we source deals, and how we structured loans to make sure that we were properly managing the risk inherent in every deal we take. So one of the things that I am excited about here is, with that background, is really thinking about, or really narrowing in on, how do we think about risk as a platform? At the end of the day, we all want to return on our investment, and that return comes from taking risks. So we all raise our hands and say, "Hey, I'm risk on today." But you might raise your hand and say, "Hey, I'm actually risk off because I think that the market's too crazy. I don't want any risk. I don't want any return on my investment. I'd rather sit with a zero at the end of the year than put my money out there and get a return." Well, right now I'm risk on private lending and residential real estate. I transitioned from commercial real estate because it looked like things were getting a little bit shaky with interest rates going up and its effect on CRE back in 22. But now I'm 100% in on residential real estate, and the reason being is residential real estate is still part of our cultural ethos. Really, people want to own a home, and single family real estate continues to be easily financeable for end buyers, and because of that, it's attainable. A lot of the lending we do today is on attainably priced homes across the U.S. And a really unique thing is that we actually have really great exposure to markets on a national level, which is interesting relative to the size of our funds. We're not $1 billion fund nationally. We're much smaller than that, but we still have national exposure. So we're able to take the time and really figure out, in the markets we're operating in, how do we make a deal work? And that's been a really good strength that I've just noticed. So I've been here for 3 months, and just something I've noticed about the way we approach risk. But one of the things I'm shifting towards is as we're looking at the interest rates we're charging and the risk we're taking on, one of the first moves I made was I thought, you know what, actually we need to increase our rates. So we've increased our rates to about 13%. It's 12.99, and that just comes from my awareness of what other private lending platforms are charging today and the risk-adjusted return that they're seeking. At the end of the day, I want to get a return that's commensurate with the risk that we're taking on in every loan. Our current strategy, I would say, for deploying capital is pretty self-explanatory. I'm assuming people on the webinar are familiar with the platform, but if not, I'll just tell you really fast in 2 minutes what I saw here at Secured Investment Corp and one of our incredible competitive advantages that actually drew me up here, and why I'm part of Secured Investment Corp today. Well, maybe I should tell that story first. So when I met Lee, he's a man of faith, and we have that in common. And we had such a strong value alignment. And then his vision for Secured Investment Corp and his lending business was so similar to what I've done in the past. It was just kind of a no-brainer. So last year, I had just finished my wife and I. We have 6 kids, and I had just finished our farmhouse down in South Idaho near Boise, and we had moved in and settled, and then we just kind of felt, really God stirring us up to move up here after I met Lee, and I realized, hey, this is where I want to be. So we've actually, after finishing our farmhouse, it's a beautiful, house on 5 acres. We're really proud of that and thankful for that accomplishment. We decided to list it and move up here. So big move, but the reason is I just want everyone to know I'm very bullish on what we're doing, and it's an exciting opportunity because what we have today is we have incredible exposure to the market at large. We can be a top of mind lender in every market across the U.S. through our broker channel, where we've educated, certified private money brokers. We have master brokers. We have different tiers of people out there looking for deals on our behalf and brokering loans to us. And that's not something I've had in the past. So most platforms don't have that exposure that we do to all the deals taking place in the marketplace. So really all we need to do is, sure, we need to tighten up our loan product and make sure we're taking the right risk for the return we're getting. But behind that, we need to make sure we have capital in our funds to address the market opportunity. And that's why I came here. I think it's an incredible market opportunity and something I'm willing to, of course, uproot my family and bring them up here. And of course, my wife is on board, thank God. And this has just been a good move. So I did want to talk a little bit about that market opportunity, because with interest rates holding steady, it's really created less transaction volume than we would like typically. If you're in the business of flipping houses, you want to sell those houses as soon as possible. But people are really sitting on purchase decisions, and people are really sitting on sale decisions. But we are seeing a little change in the air. In many markets, our borrowers who are flipping houses, they're finding good opportunities, and I think that's a really unique thing. When you have someone local to a market who's able to understand the dynamics in that market, they can spot opportunities that no one else is going to see. So national house flipping programs, like they might struggle a little bit because they're having trouble penetrating markets and really seeing the deals that are happening there. But people who are local to those markets are finding deals. And we just came off one of our strongest weeks of lending. We put out over $2 million because we had local people in different markets all across the U.S., West Coast, East Coast, Midwest, and South as well, finding opportunities in the markets that they were in. And, one of those opportunities I love, there was an opportunity out in Texas where someone found something, and I don't have the numbers in front of me, but they were able to find an incredible profit margin in this deal because it was just outside the wheelhouse that a lot of people would consider. But it was only 40 minutes from Dallas, but it's a little bit rural looking. And that's the sort of thing that I think we have a unique opportunity to target is these sort of pocket opportunities around the U.S. where all the focus might be in Dallas real estate, and I do like Dallas real estate, but and I managed a fund there for a few years. But when we have access to pocket opportunities, we're able to charge higher pricing and better address the risk because of the size we're at today, and really make deals happen, one at a time. And that's a really unique thing that I want to grow into as a platform. So I want to continue to focus on these sort of pocket opportunities and really address the risk on a deal by deal basis and build deals that protect us while still delivering strong returns and delivering a superior customer experience to our borrowers so that they keep coming back to us. The premium people are willing to pay for a good experience is a huge benefit to our funds. And the reason they can pay us 13% as opposed to paying another lender, let's say 11%, because they get such good service from us. Lake City Servicing, which is here in our office, does a great job with the servicing and keeping our borrowers happy. As I say, user experience, though, I think about the borrower experience. A lot of my first 3 months has been tuned towards borrower experience, the lending platform. And something I do want to address is for our investors. I would say the investor experience has been less than what I think it ought to be, and we've had some issues with I think the way we manage and communicate to investors. For example, we have a couple different funds. One of those funds has many people in it, and it can take time for people to get responded to. And I want to increase our response time and just be generally more accessible to people who are invested with us and invested in our funds. Um, we are making some structural changes there that we'll be rolling out in the coming weeks that are going to be a huge improvement to the way we manage relationships with our investors and get in touch with people and become available to them. And this webinar was part of this idea. We were having a conversation and we said, hey, what can we do for investors to narrow the distance between us, to have a better direct connection? And I just was very excited to meet people. So, the webinar idea surfaced, and I was very excited to do this. So, with that said, I would love to just do a little meet and greet, I guess. If people want to ask any questions, I would love to have a chance to explain a little bit more about my background, talk a little bit about what the next 6 to 18 months should look like for Secured Investment Corp and our funds, as well as our lending activity. And with that, I will open up to questions, and let's see if I can find questions over here. All right. Does anyone have any questions?
Andrew, I have one, and
Yes, sir.
actually, and it's Chris is asking about this. He's asking about the divestments and when that will begin again. What's the plan in regard
Yeah.
to redemptions?
Sure. Okay. Yeah. So one of the first things I found out coming here was that we had paused divestments for Fund 2 and Fund 3. And Charlie, let me know if I missed anything, but I think I've got the details down. We've actually created a model now, and I own this. Tim Lum, who's one of our investment associates here, he and I are putting together a model for exactly how to roll out the divestments, because we don't want to hold on to anyone's money who doesn't want their money invested in the fund. But now I also recognize that to maintain the health of a fund, if you have, say you have a $50 million fund and 5 million people want out next quarter, well, you have to make sure that that ties in with loans paying off, new capital coming in. You just have to make sure the timing's right. So now we have a model that Tim is going to finish today, actually, and we're going to look at and get confirmation that we can start opening those up. The plan is to start opening this up in June, or rather, let me be clear, is to have our plan in place by June 1st with the earliest access to redemptions beginning in June. And the way this works is it's done pro rata across every investor who's raised their hand during the period in which divestments were paused, which I think is maybe the last 3-4 months, 6 months. I'm not sure how long they've been paused for, but over that period. This plan was so I had to talk to Armanino, who's our auditor, our third party auditor. So we hire Armanino, which is a great firm. I knew Armanino before I knew Secured Investment Corp. They're a fantastic auditing firm, and I was happy to see that that was our auditor, because what it means is we go to them with a plan. They say, yes, this works. This is equitable and fair to all of our investors, and then we can move forward with confidence that we're doing the right thing. And I have confidence that we're moving forward with a model that will do the right thing. So I've already discussed this with our auditors. This was, 2 weeks ago. They gave us the thumbs up, the green light to move forward with this. Now we just have to carry it out, set up the model that we'll use then to distribute money. Yeah, Charlie, anything else on the divestments? I know that is something that I'm sure people are curious about, and I just want to make sure I answered that question well. I don't think other people have audio. I think it's just me and you, Charlie. Is that
Yeah.
right? Okay.
If you guys, if you have any questions, you can drop them into the chat, and I will pass those along to Andrew. Yeah, there will be more communication about redemptions over the next month. So look for
Mhm.
those emails and any conversations that you might have with your account rep on that. One thing, Andrew, if you could speak to just how speed factors into our lending and how that can be a tool to scale. I know you've been working on that, getting our close times, narrowing those down. Can you speak to that a little bit?
Yeah, so that's a great that's a whole thing we could talk about, because um, the borrower experience really drives our place in the market as an investment platform. So as an investment platform, we can only close on investment opportunities that we see. If we want to see thousands of opportunities so that we can select the best hundreds of them that fit our box and that we're confident are good investments. We need to provide superior customer experience. And one of the things, I mean, really the most critical piece of customer experience is closing timelines. And I don't have it on my whiteboard anymore, but on my other whiteboard, which is actually in the hallway, I've outlined this entire lending process that's based on, in the past, when I was closing 150 loans a month, this is how we did it. So I have this whole process mapped out on how we can do that, how we can scale that here, and adopt really the way I've done things in the past, and do things, really in a better way here at Cogo. And I think it's going to be really, really beneficial to our borrowers. They're going to love Cogo even more, and that's going to allow us to see more deals. And then with all those deals to fund, we'll be able to choose the very best loans to close as fast as possible, and we'll need more capital for that. And today we do have capital, so that's good. I actually did just get off, and we'll communicate more with that. But I just had someone green light us for another $2 million. This was yesterday, so I got good news on that. We have more money coming in, and I'm really happy about that. That's a big investment and a big win for the platform. That's on fund too. But anyways, my thought too on timing is, I think in the past we've been closing loans in, let's call it 30 days. I want to cut that in about half. I want to get down to 14 days to close. And what that means is we're taking appraisals, which we farmed out to appraisal management companies that often take up to 2 weeks to get us an appraisal back. And we're doing appraisals now that should be back in 3 days. And on top of that, we're internalizing the valuation model to say, hey, I know our appraiser said it's worth this amount, but we're actually going to take those comps, we're going to run it through our own underwriting model, and we're going to verify everything and confirm it's accurate. And that's what I've done in the past. We've always owned valuation in-house. So yes, we have third-party values that are confirming value, unaffiliated with us, third party, but let's also be responsible in this office. Let's be a team of real estate investment professionals and say, I can see the merit in this investment. I agree with this value. This is good. And then we need to be really confident with the way we say yes. And then also gives us ability to be confident when we say no. And that's a big part of speed, right? It's someone brings us a deal, we give them a quick, firm yes or a quick, firm no. And we don't waste our time in the gray area. So that is helping speed up deals. A key part of how we've sped up deals too, this is kind of getting to the weeds, but maybe it's interesting, is I act as a portfolio manager. My goal is to build the best portfolio of loans that I can bring to our investors and bring to the market in general as, hey, look at these loans, these are the best. And how I do that is I make a buy decision on every loan that comes across my desk within 60 minutes in a day. So we have our team setting up, processing. They do something called order entry. They intake the loan application. But before we even accept a loan application, I'm looking at it. I'm saying, yes, this looks good. I'm looking at the people, the property, the package. People being the borrower, their experience, track record, net worth, liquidity. The package meaning the financial instrument. So what is our leverage? Are we 65% LTV? Are we 50% LTV? Are we 90% loan to cost? Are we 100% loan to cost? What are we being paid for the risk and the leverage we're giving this person? And then, so people, property, package. Oh, and then property. What is the property relative to the comparable sales in the neighborhood? How is it compared to the competition? And from a macro standpoint, where is this in the US? And are we risk on or risk off in that market? So I do that all within about, and it doesn't take me 60 minutes. What I'm saying is we have all this information prepared. It comes to my desk, just in my inbox. Within 60 minutes, I open up our file, which is, we've adopted a new technology through the mortgage office where we process our loans now. And that was a new initiative I did, but we don't have to get into that. So now we open up the mortgage office, we look at the loan file, I look at the loan file, and it just takes me a couple minutes to make a buy decision on these because I've been doing hundreds of these a month for the last, for years. And so I look at it really quick and I say, yeah, that's a loan I want to buy for our portfolio. So yes, go ahead, accept the application. And once I say yes, then they order the appraisal, they order the title insurance, they reach out and make sure that we have property insurance in process, and they really set up the whole package for success right there the moment I say yes. And that gives our borrower instant feedback that yes, we've accepted your application. The people, property, and package all look good. They're all conforming. We can make sense of it. It's going to be a good investment for us. Go get us all your documents. We'll close as soon as you get it back to us. So from there, we should be able to close deals in about 14 days because we're making that decision up front based on people, property, package initially, and then we're vetting and confirming that all the things that they presented to us are in fact accurate. That's hugely sped up timeline. Charlie, that was a good question. It sparked a lot. Charlie or anyone else? If I stirred up anything in that response, let me know. There's so much to touch on with the changes. We've been hard at work, pretty
Yeah.
much refining every bit of the lending process and also the investor experience in terms of returns and how we're managing performance.
Yeah, and I love that you brought up what you're doing on a daily basis because that's something I see. You're in the trenches, working with the teams,
Yeah,
making deals happen. That's exactly what we need right now. Um, can you maybe speak to a little bit to your 0 to 1 initiative for our brokers? Because that's another thing that
yeah,
I see as really
yeah.
helping us scale.
Yeah, so beyond the processing, one of the things that we've identified is we have this massive opportunity with brokers all across the U.S., hundreds, actually thousands of them. I'm learning more and more as I'm here, just truly how unique this is. We have thousands of brokers on the cusp of success of getting their first deal done, and they're sending us deals and they're almost working. Well, I just said, hey, you know what? Let's just create an initiative. We're going to call it 0 to 1. So we want to get our brokers from doing zero loans to doing their first loan, and how we do that is we equip them with the same tools that we use to qualify loans here in the office. We equip them with that upfront so they can see a deal, they can really quickly determine is it a good deal or not, and then they send it to us if it's a good deal, and we say yes and we confirm, and then we stand behind them. We back them up. We say, hey, we can see the merit in this deal. Let's go through the facts, do our final formal underwriting, of course, but early on, in those first 60 minutes of us accepting an application, let me get eyes on it and make a purchase decision. Say, yeah, that looks like it's going to be a good deal. It makes sense as long as the facts check out. Trust but verify. And we really do. We lean on our brokers for that, and they're giving us tremendous deal flow today. In fact, that all $2 million of lending that we just that we just got done doing, one of our best weeks was it was 100% from brokers. So people that have gone through the Lee Arnold system of real estate, who've been trained and equipped with us with how to analyze deals and bring us deals that make sense. So that was a good week, and that was 100% our brokers. So it's working, and we're seeing things that are working. We have a lot of clarity, I think, around how we want to utilize our army of brokers out there, how we want to activate them, and then how do we handle the volume they're bringing us? Because my thought is we have so many deals, we need to grow our capital base to even handle all these deals. So how do we handle this volume and make sure we're just catching the very best deals? How are we processing through underwriting? How are we thinking about risk? And are we asking the right questions? On that note, another thing I do is I actually manage I'm well, I help manage the Lake City servicing team who's out there servicing the loans we make on the funds. And we're creating ways to recognize patterns that lead to problems for loans. So red flags like, oh, this person was supposed to be done with the renovation project in 3 months. It's taken them 6 months. Why? So we red flag that. We look at, okay, so really what's the slowdown? What's the holdup? Someone asks for their entire contingency budget day one. Okay, red flag. Why do they need their contingency upfront? We're not going to front load things. No, you go do the work. We'll fund you money when the work is done, right? So these sort of things that have already been in place, but especially now that I'm here and I have the experience of doing this at other platforms, making sure industry best practices are in place, all the way from the origination process, well, the brokers, the origination, order entry, processing, underwriting, closing, servicing, payoff, right? Like I've sat in every one of those positions. Personally, I've done the work, and I can make sure that every person is doing their job. Because remember, my background is an underwriter, so I look at everything from a risk lens. I don't look at sales from an opportunity lens, like, oh, I can't wait to make more money. No, I think let's take care of what we have today. Let's be good stewards. The parable of the minas, the talents. The stewards were supposed to invest on behalf of their master. The biblical parable comes to my mind all the time. Like, okay, let's be faithful with what we've been given, and then much will be added to that if we're faithful. So that's why I'm here. Be faithful for this. But I do recognize that as I am faithful to the opportunity we have in the marketplace, we could probably expand this platform to, I don't know, it's really unlimited. We could do hundreds of millions of dollars of good loans every year. I'm confident in that. And I'm excited to get there. Because at the end of the day, we all want that diversity. We all want to be in the best markets and have concentration in the best markets, but still be dispersed among the top 5, top 10. Today, our portfolio, how many loans do we have today? Across the board, let's call it 100. And it might be a little more, a little less. I'm not sure what that number is. because I don't have it in front of me. But next time I do one of these, I will, because I want to dig into the portfolio. But let's say it's 100 today. Well, I'd rather have 1,000 loans. If I'm investing $1 million in a lending platform, I'd rather have my $1 million spread across 1,000 loans than just 10 or than just one. I love that diversity, and it's a numbers game at that point. We should all expect that some loans are going to go south. We're going to have to take back loans. We're going to have to foreclose. I was at an organization before. I'll just say we were making close to 200 notes loans in a month, and we were also taking back foreclosing 5 properties a month. That's just what we did. We did it every month, and it was okay. We lost money on those loans that we took back, but we made enough money on the good loans we made that it didn't matter. And that's just what you expect when you're managing a platform at scale, like we're heading towards. And I think that's going to be really good. I think I just got a note here that we actually have 80 loans on the portfolio, just about 80 loans on the portfolio. So I was pretty close at 100. But I would love to see that 80 notes grow to 800. I would love to 10x it. Okay, I am seeing a question pop up here. Charlie, do you see these questions?
Yeah, you can just take them as
Okay,
you
I'll
as they
yeah, I'll
come if you
jump in.
want
Okay.
in.
Okay, can I speak to how it's so someone asked, can you speak to how it's determined which of the SIC funds is used to fund a loan? That's a great question. We essentially do round robin based on available liquidity at the time. So neither of our funds are levered. If they were levered, we'd be sitting on excess gunpowder that we could just deploy a bunch of loans at a time. But really it just depends on if one fund does a loan, then we'll do the next one on this fund and we just go back and forth. If say fund two doesn't have money and it's their turn to fund, well, then it's just going to go to fund three or vice versa. It just depends on the cash available. Our cash available is determined by, like I said, new investments coming in and loan payoffs. So for example, fund two, we just got confirmation of 2 million additional dollars. That's going to be coming in the next few weeks. So we got confirmation today, but it's going to take a few weeks to process. That's going to be a good amount of liquidity. So we'll be able to do a lot more on fund two. Let's see. Next question, and let me know if that answers the question. If not, just let me know in here. I can dive into it more. Okay. Are you looking at increasing preferred rate? Even if it went from 9 to 10, that would be ideal. Also, any chance of payments monthly versus quarterly? Okay. Well, good news on monthly versus quarterly. I have to talk to the fund managers. I am one of them. In the past, I've managed funds that did monthly distributions of cash. I really like that. If we can figure out the way we're doing accounting, and I'm not very familiar with that today, but if we can figure out the way we're doing our accounting here in house, I could definitely push for a monthly distribution of profit. I like that question. I would love to do that. Another question, are you looking at increasing preferred rate? Okay, yes, that was what I was just reading. So the preferred rate of return is today, it's at 9% in Fund 2. Tim, if you're on, can you just confirm for me? I think Fund 2 is 9%, Fund 3, 6%.
That's correct.
That's correct. You
Yeah.
got it. Okay. I got double confirmation. Tim messaged me too. Okay. The reality is market is 8% pref with a split after pref. So regardless of where the preferred rate is for me, I want to be targeting returns of 10 to 11%. So whether that's first 9 goes to you, that means that you're getting less after. If the first 10 goes to you, that means you're getting even less. I would actually like to see an 8% pref with an equal split of profit after that. But at the same time, I just have to visit what we've done today and what people's preferences are in the fund. It doesn't matter a lot to me because at the end of the day, I want our investors to be happy, to be getting the risk or getting the return commensurate with the risk they're taking on by lending and private lending. And the preferred rate doesn't impact the bottom line rate much if we're hitting our goals and we're hitting pref. So let me see. Last quarter, in Fund 2, for example, I think we got really close to pref, but I don't know if we reached it. So in that case, it wouldn't have mattered anyway. So say we only return 8% on an annualized basis in one quarter. Well, we're not hitting that 9% anyway. So, we're not even at 9. But if we hit 9, then you're trying to say 10. Then us as a manager, we don't get paid until you get 10, right? So that's how pref works. I'm open to anything, but I don't think it's market. I think market is 8% pref. I would be surprised to see a fund doing 10%, unless it was a levered fund. Here's how a levered fund works. If they're doing high leverage, someone might raise $10 million and go get $30 million of debt, and now you're at a 3-to-1 leverage ratio, and you could expect returns of 16%, 17%. It would be wonderful, but also a lot riskier. I would rather be the bank than pay the bank. And but leverage has its place. It's good working capital, and I'm not opposed to judicious use of leverage just as a cash flow management tool, not necessarily as a yield enhancer for the way our funds are set up today. Okay, Sue, let's see. I see another question here. With the round robin funding, how does that give our fund a different rate of return than the other funds with lower preferred rate? Or fund different? So the rate of return and performance in a fund is just relative to the assets and the performance of that fund. You could have two funds that are looking at similar deals and performing differently. I know we have real estate holdings in both funds. Going forward, my plan is to focus on private lending because that's my background. And if you remember from earlier, I was saying I lost money flipping houses. Well, I made some money at first and then I had a big loss. And that was around I was actually lending while I was flipping. And funny, on that flip that where I lost $80,000, the lender still made their 10, 11% a year, and they were very happy. They didn't even know we lost money. They had no idea. We're the only ones that knew. So I really like lending. And just from a return on time perspective, for a management team to flip houses, that's using a different part. That's just a different process and function than building a really good lending platform. So we can build a really good lending platform. We can build a really good flipping platform or a really good commercial real estate investment management platform. We can do all of those things. But for the next 6 to 18 months, my focus is on private lending. And I expect our returns to match typical private lending returns, right? So if you're seeing other funds getting 9 or 10%, that's what I'd expect from us. I'm not sure I understand the question that why would, there's no reason that if one fund gets a loan at 11% and another fund gets a loan at 11%, that they're not both returning similarly, unless there are other details there that I'm missing. And quite frankly, between our two funds, Fund 2 and Fund 3, I don't know the way returns are paid out and the waterfall or just those metrics on why you'd have a disparity between the two. I would expect similar rates of return in both funds, unless, for example, Fund 3 was holding a bunch of flips that weren't generating any cash flow, and then we're just waiting on those flips to sell off to boost returns. In that case, we do operate as an income fund, but how do you create consistent income from flipping houses? Well, you have to have consistent flips every month to do that. So if you have a lot of exposure to flips, you're not going to get consistent income. So your rate of return would definitely vary if you're overweighted in real estate holdings and sales. Maybe that's the case between the two funds if the returns are very different. Okay, that was a lot of response to those questions, and I just feel like I'm talking so much. I would love sometime, Charlie, to do one of these where we can get even more engagement and maybe interview other team members and talk about things that they're seeing. I know Tim and Lisa are out there every day talking to investors, seeing people or seeing the questions and the issues and the opportunities that are coming up. And I think that could be really good. But yeah, that's it for me. And I don't see any more questions. Charlie, have we hit everything that you wanted to hit today?
We have, and to just follow up on what Andrew said, we will be doing more of these. We want to, like he said initially at the beginning of this call, we want to open up lines of communication with our investors. So we're going to be working hard to do that. Let everyone know there will be a replay of this. I will send that out before the week is out. But thanks for being on the call today. And we appreciate you guys. And again, we'll be reaching out more and you'll be hearing more from Andrew in the future.
If you want to learn more, just click the link below.